Why does the government raise and lower interest rates? We are Kaizenergies, a channel about health and positive energy. We're diving into a topic that affects us all, interest rates and why governments raise and lower them. It's a complex but essential aspect of economic policy that can have a significant impact on our finances. We'll explore the reasons behind these interest rate changes and why they matter to you. Before we discuss why governments adjust interest rates, let's clarify what interest rates are. Simply put, interest rates are the cost of borrowing money or the return on investment for lending it. When you save money in a bank, you earn interest. Conversely, when you take out a loan, you pay interest. One of the primary reasons governments raise or lower interest rates is to control inflation. Inflation is the rise in the general price level of goods and services over time. When inflation is too high, it erodes the purchasing power of your money, making goods and services more expensive. Lowering interest rates is a common tool governments use to stimulate economic activity during times of recession or slow growth. By reducing the cost of borrowing, it encourages consumers and businesses to spend and invest more, boosting economic growth. Interest rates are a key component of a country's monetary policy. Central banks like the Federal Reserve in the United States use changes in interest rates to achieve specific economic objectives. For example, raising rates can cool an overheated economy, while lowering them can spur economic activity. Interest rates can also impact exchange rates. When a country's interest rates rise, its currency tends to strengthen, making exports more expensive for other countries. Conversely, lower interest rates can weaken a currency, potentially boosting exports. Interest rate changes have contrasting effects on savers and borrowers. Higher rates benefit savers by offering better returns on their savings accounts, while borrowers face increased borrowing costs. Lower rates, on the other hand, make borrowing cheaper but reduce returns on savings. The housing market is particularly sensitive to interest rate fluctuations. Lower rates make mortgages more affordable, potentially increasing home buying activity. Conversely, higher rates can cool the housing market by making mortgages less accessible. Interest rate changes can also influence the stock market. Lower rates often lead to higher stock prices as investors seek better returns than what they can get from bonds or savings accounts. Conversely, rising rates can lead to stock market declines. Governments consider interest rates when addressing unemployment. Lowering rates can encourage businesses to expand and hire more workers. However, this effect may take time to materialize. In conclusion, governments raise and lower interest rates for a variety of reasons, from controlling inflation to stimulating economic growth and managing exchange rates. These changes can have a profound impact on your personal finances, affecting everything from your savings and investments to your borrowing costs and even the price of your home. It's essential to stay informed about these shifts and understand how they might affect your financial situation. If you found this video informative, please give it a thumbs up and consider subscribing for more content on economics, finance, and personal finance tips. Thank you for watching, and remember that interest rates are a critical tool governments use to steer their economies towards stability and growth.